Welcome back to the Deep Dive. You gave us a formidable stack of source material, and we've distilled it down to the most critical nuggets of knowledge and insight.
We certainly have.
Today, we are dissecting an American institution that has achieved a paradoxical level of omnipresence and profitability, yet finds itself embroiled in intense scrutiny and resistance. We are talking about Dollar General, or DG.
That's absolutely right. When most people think of major American retailers, they focus on the giants dominating e-commerce or massive metro areas. But Dollar General has quietly and just relentlessly built a physical footprint across rural America that is, frankly, unmatched.
Right.
We are looking at a company that is not just huge, it's an S&P 500 component, headquartered in Goodlettsville, Tennessee, with a corporate narrative that is as impressive as it is controversial.
Okay, let's unpack this enormous file. We have to cover everything from their Depression-era origins and the genius of their initial pricing strategy through to their aggressive diversification into new store concepts, their complex financial structure, and, critically, a truly extensive stack of corporate critiques. We're talking everything from systemic worker safety issues to accusations of contributing to economic decline in the very towns they claim to serve.
And our mission today is precisely to explore this tension. How did Dollar General achieve this paradoxical scale? They managed to become one of the most profitable retailers in the entire rural U.S., reaching nearly $38 billion in annual revenue, while simultaneously facing legal battles, massive regulatory fines, and, grassroots resistance.
Yeah.
To understand the future of American small towns, you really need to understand the mechanics of this giant and the trade-offs it constantly makes.
And when we talk about mechanics and scale, the figures are just colossal. Learner, listen to this. As of early 2025, Dollar General boasts an astonishing 20,388 stores.
20,000.
To put that into perspective, that is a store count that dwarfs almost every other major chain, demonstrating a geographic density that allows them to reach populations no one else bothers with.
And that dense footprint requires an immense workforce, which stood at about 170,000 employees as of 2023.
Wow.
And this infrastructure generates staggering financial results. If we look at their 2023 fiscal year, the company reported $37.885 billion in revenue.
$37 billion.
And logged a very healthy net income of $2.416 billion. These aren't just figures. They represent a machine perfectly optimized to extract value from the discount retail sector, particularly in underserved markets.
So we have the modern empire, but how did they establish the operational DNA needed to achieve this level of efficiency and saturation? Let's turn back the clock to the very beginning and examine the genesis of this giant, starting way back in 1939.
Understanding the origin story isn't just a fun history lesson. It tells you exactly what Dollar General's core business model is built upon.
Which is?
Closeouts, relentless efficiency, and capitalizing on the gaps created by economic upheaval.
It all begins in Scottsville, Kentucky in 1939 with James Luther J.L. Turner and his son, Cal Turner. You have to consider the economic backdrop here. I mean, the country is struggling through the tail end of the Great Depression. This context is absolutely fundamental to JL's initial business model.
Yes. Unlike traditional retailers who bought fresh inventory, J.L. Turner's specialty was essentially being a professional liquidator. He started by traveling and buying up the inventory from bankrupt general stores across the region, taking on the risk of assets nobody else wanted.
So he was kind of a business vulture, in a way?
You could say that.
Yep.
But his son, Cal, gained crucial business skills not in running a store, but in assessing and maximizing returns on distressed inventory. This obsession with finding deeply discounted goods, the closeouts, gave them a massive long-term sourcing advantage.
They took this operational concept and formalized it. They officially opened J.L. Turner & Son in October 1939. The initial investment was $5,000 from each of them, which, adjusted for inflation, translates to approximately $113,000 in 2024.
Which was a substantial amount to launch a serious business at that time, focused primarily on wholesale and liquidation initially.
Right.
And that efficiency and low-cost sourcing translated rapidly into retail success. By the early 1950s, J.L. Turner & Son had pivoted from just liquidation to successfully running 35 department stores scattered across Kentucky and Tennessee.
35 stores?
Yeah, and annual sales quickly topped $2 million, which proved that their model could sustain conventional retail operations.
But the real inflection point, the moment the company became Dollar General, that came in 1955.
It did.
This was Cal Turner's singular genius stroke. He decided to convert Turner's department store in Springfield, Kentucky, into the very first Dollar General store.
And this was a revolutionary concept in retail at the time because it simplified the entire consumer value proposition. It was based on the Dollar Days promotions that were incredibly popular, where department stores would briefly offer heavily discounted items for $1.
Right, I've heard of those.
Cal simply made that the permanent policy for the entire store. Everything sold for $1.
That's brilliant.
It offered extreme price clarity, removed the complexity of internal promotions, and cemented the image of unmatched value.
That clarity was key. The name Dollar General Corporation was officially born in June 1955. And I imagine that simplicity drove rapid expansion.
It did, and the growth demanded a change in leadership and funding. When J.L. passed away in 1964, Cal Turner took over as CEO. Just 4 years later, in 1968, the company went public on the New York Stock Exchange.
Wow, that's fast.
It demonstrated that the dollar model was sustainable and scalable enough to attract major external investment.
By the time they went public, they were already posting annual sales of over $40 million.
$40 million. But the true period of hypergrowth began when the third generation, Cal Turner Jr., took the reins in 1977.
What did he do?
Cal Turner Jr. didn't just maintain the growth, he accelerated it massively. He oversaw the crucial move of the company headquarters to Tennessee in 1989, centralizing their corporate functions. Under his leadership, the sheer scale was established. By the time he retired in 2002, the company had exploded from a regional chain to a national power.
What are the numbers?
Boasting more than 6,000 stores and achieving an incredible $6 billion in sales. This is the era that solidified the foundation for the 20,000 store footprint we see today.
And as that store count grew, the infrastructure had to keep pace. I mean, you can't supply 6,000 stores from a single warehouse.
No, you can't. They established massive distribution centers like the one in South Boston, Virginia in 1997, which allowed for the economical supply of thousands of stores, often in very remote locations.
So the logistics game as much as a retail game.
Absolutely. Their ability to manage inventory and logistics efficiently is what allowed them to breach the $4 billion sales mark by the year 2000, earning them a permanent spot on the Fortune 500 list in 1999.
So they're a huge success. But the next chapter, the private equity chapter, you said this is crucial. Why?
Because it was a surgical upgrade to the company's operational ruthlessness.
Okay, here's where it gets really interesting because it highlights the intense focus on operational metrics.
Yes. In 2007, a consortium of powerful private equity firms, including KKR, GS Capital Partners, and Citigroup Private Equity, executed a massive leveraged buyout. They acquired all publicly listed shares for $6.9 billion. This valued the company at $22 per share.
And private equity firms, as you said, they don't invest nearly $7 billion to run a charity.
Exactly. Their focus is intense optimization for profit extraction. During their tenure, they implemented what was known as the Easy Stores model.
Easy Stores. What does that mean?
This wasn't just a marketing gimmick. It was a brutal strategic assessment of every single asset in the company's portfolio as those store leases came to an end.
And the criteria they applied revealed everything about Dollar General's future strategy. They were assessing locations based on logistics efficiency, demanding things like adequate parking, immediate access to a loading dock, and dedicated spaces for garbage dumpsters.
Exactly. Why loading docks and dumpsters?
I was going to ask.
Because in the world of high-volume, low-margin retail, speed of restocking and speed of waste removal, the logistics turnaround time directly dictates profitability. If a store couldn't efficiently receive a 53-foot truck and cycle its inventory, it was considered an inefficient asset. This initiative led to the closure or relocation of over 400 stores deemed operationally inefficient.
So they were willing to sacrifice immediate revenue from 400 stores for future systemic efficiency.
That's it. They were ensuring every remaining store was a part of a perfectly oiled supply chain machine. That mindset is absolutely core to their current 20,000 store sprawl.
That's a key nugget for you, the listener. The Easy Stores model proves that Dollar General is, at its heart, a logistics company that just happens to sell cheap goods.
Right.
And this private venture was short-lived but highly impactful. In 2009, having implemented those crucial efficiency changes, Dollar General filed for a new initial public offering of up to $750 million.
Returning to public trading with a fundamentally hardened and streamlined business model.
We transition now from the genesis of efficiency to the modern operational empire, defined by saturation and diversification. If the first phase was about inventing the dollar concept, this phase is about maximizing geographic density to squeeze profit from every possible corner.
The scale is intentional. We mentioned over 19,400 stores across 48 states, the District of Columbia, and even Mexico as of early 2025. Their strategy is often described as running toward the retail apocalypse.
What does that mean?
They're deliberately targeting small towns and rural communities, places where the competition, like traditional grocers or even small department stores, has been decimated or never existed in the first place.
They are systematically filling in the map.
Yeah.
I mean, they only recently entered Wyoming and Washington in 2020 and Idaho in 2022.
But when you want to see the sheer power of their saturation strategy, you have to look at the market leader, Texas.
Texas alone holds an enormous concentration with 1,755 locations. That speaks to the profitability of their Deep South heartland focus.
And to support that kind of density, you need an incredible infrastructure.
You do. One that can handle continuous supply for thousands of remote locations. DG maintains 17 distribution centers across 16 states. These hubs, like the major ones opened in Bethel, Pennsylvania in 2014 and San Antonio, Texas in 2016, are the essential circulatory system that ensures shelves in even the most remote Kentucky or Idaho town are consistently restocked.
But the modern empire isn't monolithic, right? DG has demonstrated a willingness to diversify their store formats to chase very different demographics and spending habits.
They have.
Let's look at the evolution of these concepts, starting with their first big shift, the move into food.
That was the Dollar General market, introduced way back in 2003. This signaled the company's commitment to going beyond non-perishables and competing directly, if, cautiously, with traditional grocers.
And the crucial component here is the expansion into fresh produce.
Yes.
By 2019, they were offering produce assortments in over 650 stores, with plans to expand to 400 more in 2020. This move is a direct operational counter to one of the most potent critiques they face.
That they contribute to food deserts.
Exactly, by only offering shelf-stable processed goods.
And surprisingly, when they do offer fresh goods, the quality often isn't the issue their critics assume it is. A 2019 study from the University of Nevada, Las Vegas, actually indicated that the quality of fruits and vegetables at dollar stores was comparable to that found at larger traditional grocery chains.
So the issue shifts from quality to access and selection.
Exactly. When they commit to it, they can deliver it.
Okay, so the next major diversification was moving in the complete opposite direction, urban density, with the DGX concept, launched in 2017.
DGX is a textbook example of adapting format to environment. These are much smaller footprints, intentionally targeting dense city centers and high foot traffic.
And the focus is different, too.
Very different. The focus is on instant consumption, things like ready-to-drink beverages, snacks, quick-serve coffee stations. They launched in Nashville, Raleigh, and Philadelphia. This clearly signaled that DG's ambitions weren't limited to rural isolation. They wanted a piece of the city convenience market, too.
And then came the biggest strategic pivot, the creation of pOpshelf in 2020. This is Dollar General attempting to move beyond just discount retail and into, aspirational discretionary spending.
That's a perfect way to put it. pOpshelf is fascinating. It's built on the premise that suburban shoppers, often suburban moms, are looking for trendy and elevated items.
Like what?
Think home decor, crafts, seasonal goods, and beauty, where most items still retail for $5 or less. It's higher margin, non-essential inventory designed to capture the kind of spending that might otherwise go to specialty stores like Hobby Lobby or Target's home section.
That is a huge demographic shift and a different inventory focus entirely.
It is.
It relies on trend spotting and faster turnover of fashionable goods, which has to be a massive logistical challenge compared to just stocking 6-packs of soda and canned beans.
It is, and the speed of their learning curve is evident. By 2024, pOpshelf had already expanded to 200 locations, proving the concept had merit. But the company quickly realized a crucial demographic mistake. They tested a store-within-a-store model inside Dollar General markets, and the senior VP of pOpshelf noted in late 2024 that they were discontinuing it.
Why the immediate reversal on that?
Because the core demographic of the rural Dollar General market shopper, the value-focused, necessity-driven customer, simply wasn't interested in spending on elevated $5 craft items.
The shoppers didn't overlap.
Not at all. The trendy suburban shopper targeted by pOpshelf and the rural necessity shopper of DG Market did not align. It's a crucial lesson in segmentation. These concepts have to remain physically and psychologically separate to succeed.
Let's shift to merchandising. While they stock national name brands, Clorox, PepsiCo, Nestle, Their margins depend heavily on their extensive private brand portfolio.
Oh, absolutely. The private label strategy is central to their profitability. They cut out the middleman and control both quality and cost. We see major lines like Clover Valley for groceries, which is a huge volume driver, Good and Smart targeting the health-conscious shopper, and Smart and Simple for the extreme low-end discount segment.
But the genius of their private label strategy comes from licensing established, respected names, specifically Rexall and Bobby Brooks.
And that's a brilliant strategic move. Rexall, for instance, has a history dating back to 1903 as a pharmaceutical powerhouse in America.
So they don't have to build trust.
They don't. DG doesn't have to spend a decade building trust in their health supplements and over-the-counter medicines. They simply license a name that already has historical credibility and positive association in the health space. They've done the same with Bobby Brooks for women's apparel. It gives the customer a perceived quality upgrade without incurring the cost of manufacturing an actual national brand product.
They also have specialized private brands, like Nature's Menu and Heartland Farms for pet supplies, and True Living for housewares.
Right. This level of vertical integration means they control almost every inch of shelf space and price point, ensuring the competition is constantly fighting against a DG-owned equivalent product.
Okay, before we move on to the corporate impact, we have to spend time on two massive recent operational shifts.
Yes.
Because they underscore the constant pressure this giant operates under and how quickly their strategy can pivot in response to internal or external forces.
The first, of course, was the leadership upheaval in October 2023. Todd Vasos returned as CEO, replacing Jeff Owen, signaling a significant course correction.
And the board's statement was uncharacteristically blunt about it.
It was. They stated the change was necessary to restore stability and confidence in the company moving forward. When a company that generated nearly $38 billion in revenue has to fire its CEO and bring back a predecessor, it signals fundamental issues.
What are those issues?
Analysts pointed to slowing comparable sales growth and mounting operational and safety critiques we'll detail later. The message was clear. The system was starting to break down under the pressure of hypergrowth.
And the second major shift was the self-checkout reversal in mid-2024.
A huge story.
Dollar General shut down self-checkout systems in over half of its stores, a staggering 12,000 locations, directly citing losses from theft or shrinkage.
Think about the magnitude of that reversal. For you, the listener, self-checkout is implemented solely to cut labor costs. It's one of the primary efficiency levers in modern retail.
So to walk away from it.
To walk away from the labor savings in 12,000 stores tells you that the shrinkage, the theft losses, were so astronomical, they completely negated the primary operational efficiency gain.
They were losing more money than they were saving.
They were actively losing more money to theft through this labor-saving technology than they were saving on employee salaries. It's the ultimate operational balancing act failure.
And it proves that even the most optimized company has a breaking point where cost savings applied at one point in the supply chain labor get completely canceled out by losses at another point, inventory control.
So we've charted the growth and the operational model. Now let's explore Dollar General's corporate footprint beyond the four walls of the store.
The infrastructure that makes the entire machine run, their public image efforts, and how they allocate philanthropic resources.
And the infrastructure is deceptively complex. While DG's brand identity is purely domestic, the supply chain is deeply global.
The structure is managed through key subsidiaries. First, there's Dolgen Corp, LLC, which is the wholly owned subsidiary responsible for manufacturing the Dollar General brand products.
Then there's Dollar General Global Sourcing Ltd., which has been critical since 2004. This subsidiary operates an office in Hong Kong to manage global procurement. This ensures that the low-cost model is maintained not just through efficient domestic logistics, but through direct oversight of sourcing operations, especially in low-cost Asian markets.
So that's how they guarantee those extremely competitive price points for housewares and general merchandise back in the U.S.
Exactly. It's a sophisticated global procurement network supporting a deeply localized rural retail strategy.
Now let's pivot to an area where Dollar General consistently draws positive attention. The Dollar General Literacy Foundation.
The foundation, active since 1993, has truly significant metrics. I mean, they have awarded over $182 million in grants, aiding more than 11 million individuals.
And what's the focus?
The focus area is helping adults learn to read, preparing people for high school equivalency, or assisting new immigrants in learning English are crucial community needs, especially in the areas DG operates.
The impact numbers are clear. But when you weigh that against the proposed OSHA fines and the accusation that they are actively stifling local competition,
Right.
does that philanthropic commitment truly serve as a meaningful counterbalance? Or is it merely a PR strategy that is perfectly tied directly to their store footprint?
That's the central question. What's fascinating here is the localization strategy of the giving. The foundation specifically awards funds to nonprofits, schools, and libraries located within a 15-mile radius of a Dollar General store or distribution center.
So it's very targeted.
Highly targeted. This ensures that every dollar of charitable giving is placed directly back into a community where a DG store is present.
It's a highly targeted form of corporate social responsibility. It allows them to state unequivocally that they are investing in the educational future of the communities they serve.
And they are. For example, their commitment of $9.2 million in 2022 included specific earmarks for programs like Donors Choose, ensuring local classrooms benefit. It's effective optics that directly aligns with their physical presence.
Beyond philanthropy, BG heavily invested in establishing a public image that resonates with its core customer base through major sponsorships, primarily in auto racing.
A sport deeply rooted in the American heartland.
They were an enormous presence in NASCAR for years, serving as the primary sponsor for major teams like Joe Gibbs Racing, supporting high-profile drivers such as Matt Kenseth and Brian Vickers.
And they also backed Kyle Busch Motorsports. Their reach wasn't limited just to stock cars either. They sponsored Sarah Fisher Racing in the IndyCar Series from 2008 to 2012.
These weren't small deals. These were massive expenditures designed to place the Dollar General logo in front of millions of Americans every weekend, solidifying their identity as a working-class, value-focused retailer.
They also entered the college sports arena, becoming the title sponsor of the Dollar General Bowl in Mobile, Alabama from 2016 to 2019. It created a national televised brand presence during the bowl season.
But those days are over.
Largely, yes. Those major sponsorship eras have concluded. They withdrew from NASCAR at the end of the 2016 season and pulled their title sponsorship from the bowl game in 2019.
Why the change?
It suggests a strategic shift in marketing dollars, perhaps moving away from expensive traditional media like racing and refocusing resources on their rapidly expanding proprietary store concepts, such as the marketing for PopShelf.
Let's briefly touch on their environmental impact initiatives as of 2024, which often reveal the company's ability to turn an environmental concern into an operational win.
They've established a significant partnership with the Arbor Day Foundation since 2021, which has resulted in the restoration of over 321 acres and the planting of more than 96,000 trees. This is a visible, positive commitment to natural resources.
And they're setting climate goals.
Clear ones, specifically targeting a 15% reduction in overall greenhouse gas emissions by 2026 and a 30% reduction per square foot by 2031. These are measurable short-term targets.
But you said this is also an operational win.
The most successful environmental initiative from a pure business perspective is their cardboard backhauling initiative. This ties directly back to the ruthless operational efficiency we discussed in Part 1.
Oh.
Instead of paying thousands of local waste haulers to remove cardboard waste from 20,000 stores, they utilize their existing logistics network. The trucks returning empty to the distribution centers are filled with compacted cardboard waste.
So it's not just recycling, it's maximizing the use of every single truck mile.
Precisely. It's an environmental win. They avoided over 1.1 million metric tons of GHG emissions through this program, but it's fundamentally driven by maximizing logistics efficiency and minimizing waste disposal costs for individual stores. It perfectly encapsulates DG where operational efficiency and corporate responsibility intersect.
Now we must confront the other side of the Dollar General story.
The scrutiny stack.
The financial success and massive scale have been built upon a foundation that has consistently drawn severe regulatory and community scrutiny on 4 major fronts. We need to detail these critiques impartially and analyze their systemic implications.
This section reveals the significant negative externalities associated with their hyper-efficient model. The first and most complex critique is centered around economic distress and food deserts.
The argument from critics is highly specific. Dollar General is not simply opening stores where economic distress exists. It's a predatory force that actively perpetuates inequalities.
Yes.
They are accused of capitalizing on the abandonment of small towns by traditional retailers and then making it impossible for healthy competition to return.
The Institute for Local Self-Reliance, or ILSR, has been the loudest voice here, detailing this phenomenon in their report, The Dollar Store Invasion. They argue DG's rapid growth has created a permanent dollar store belt across the U.S. The economic damage comes from two primary angles. First, they stifle local competition, particularly independent grocers, through predatory pricing and targeted site selection.
And secondly, the quality of jobs offered.
Yes. The ILSR analysis suggests that DG stores create fewer jobs than a local independent grocer would, and the jobs they do offer are typically lower wage and often part-time, providing less stability and fewer benefits than the local businesses they displace.
Which creates a cycle.
A cycle where the initial promise of low prices is overshadowed by long-term economic instability for the community.
This raises a critical point about the food desert argument. If a Dollar General opens and through its efficiency and pricing runs the local mom-and-pop grocery store out of business, the community has lost its primary source of fresh produce, meats, and specialized items, even if the Dollar General market concept eventually enters later.
And that's why the community pushback is so strong. We are seeing municipalities that once courted Dollar General with tax incentives now changing their tune. They are implementing strict zoning bylaws that discourage or explicitly reject new dollar store development, attempting to use legal measures to protect their commercial character and food access.
Okay, let's move to the most shocking area of critique: worker safety and OSHA violations. The documentation here points to a systemic, chain-wide problem that has put employees in constant danger.
The severity of the issue cannot be overstated. In March 2023, Dollar General was officially added to OSHA's Severe Violator Enforcement Program.
What does that mean?
This is a designation reserved for organizations that repeatedly demonstrate a flagrant or willful disregard for workplace health and safety laws. It's a regulatory scarlet letter.
And OSHA reports confirm the pattern. Since 2009, 72 inspections have resulted in 39 confirmed citations.
Which indicates that inspectors are finding consistent, repeatable violations across dozens of different locations, not just isolated incidents.
And what are these dangers?
The specific dangers are consistently life-threatening and directly linked to operational pressure. We are talking about repeated violations for blocked fire exits, which creates an extreme entrapment risk in case of a fire.
Blocked fire exits.
Yes. We see merchandise stacked unsafely, often reaching heights where it risks collapse, and basic electrical hazards, like missing faceplates on electrical outlets, creating shock risks.
Wait a moment. We're talking about a company that brings in billions, yet the regulatory body has found a consistent, repeatable pattern of blocking fire exits across dozens of locations.
Yes.
That's not a logistical error. That's an almost intentional disregard for human safety, driven purely by the pressure to stack more inventory in limited space. Is that the razor-sharp efficiency we praised earlier, just applied to dangerous con-cutting?
It appears to be the inevitable consequence of a model that maximizes inventory in a small format store while aggressively minimizing labor hours. The pressure to push product onto the floor and utilize every square inch of the backroom often overrides basic safety protocols. The financial penalties reflect the severity of this systemic failure.
In 2022 alone, OSHA proposed penalties exceeding $1 million for habitual disregard of worker safety across multiple locations in Georgia and Alabama, citing those recurring hazards like blocked exits and slip-trip risks.
The regulatory body is clearly communicating that the company is prioritizing profit margins and inventory flow over fundamental safety requirements. And this chronic disregard for safety is part of the context that forced the leadership change and the return of Todd Vasos.
Because when regulatory scrutiny hits this level, it directly impacts the financial confidence of investors.
Absolutely.
Next, let's discuss pricing and financial irregularities, which cuts directly to the core issue of customer trust, particularly for a cash-strapped demographic. If a customer is shopping at Dollar General, they rely completely on the price on the shelf being the price they pay at the register.
And this is where the system has repeatedly failed the customer. Multiple states, including North Carolina, Louisiana, Mississippi, and Arizona, fined Dollar General over $1 million combined between 2021 and 2022 for the crime of deceptive pricing.
Which is what exactly?
Charging customers a higher price at the register than the price advertised on the shelf.
Vermont hit them with an even more substantial fine in 2019. $1.75 million for the exact same pricing inaccuracies. The core issue isn't whether the price on the screen is higher than the price on the shelf, it's the consistency of the discrepancy.
And again, the systemic nature is key. If a customer is buying $50 worth of necessities and 10 items are overcharged by 50 cents, that is $5 lost.
Which is a big deal for their target customer.
For a wealthy shopper, that's negligible. For the low-income, value-focused customer that DG targets, that small, repeated loss is disproportionately harmful. The company is now facing multiple class action lawsuits and a major deceptive pricing lawsuit brought by the state of Ohio in 2022, indicating that regulators and the public view this as corporate policy, not isolated errors.
And these financial issues are not new. We have a significant history of serious accounting issues that predate the private equity era.
This history suggests a long-standing pattern of pushing financial boundaries. Back in 2001, Dollar General was judged liable for making false statements and failing to disclose adverse financial facts.
What was the outcome?
They settled for a massive $162 million and were forced to restate 3 full years of earnings due to documented accounting irregularities, including allegations of fraudulent behavior.
Then, just 4 years later, in 2005, they restated their results again for the years 2000 through 2003, following a clarification issued by the SEC regarding complex lease accounting matters.
This pattern, restating earnings, settling major lawsuits, and dealing with intense SEC scrutiny, suggests a fundamental instability, or at the very least, a management culture willing to aggressively interpret accounting rules for short-term gain.
It fundamentally complicates the image of Dollar General as purely a hyper-efficient machine.
It does. It suggests a history of operational chaos or aggressive management, leading to the instability that ultimately demanded the leadership change we saw in 2023.
Finally, let's look at how communities are organizing to fight back.
Yeah.
We see a growing trend of local resistance, where citizens actively campaign against the arrival of a new Dollar General store.
This grassroots trend is driven by a powerful desire to protect the small town's strong rural identity. For many, the arrival of Dollar General is seen as the physical manifestation of external corporate forces overriding local control, stifling local businesses, and homogenizing the community's appearance.
This resistance isn't just complaining, it's organized.
It is. The Institute for Local Self-Reliance, having offered the dollar store invasion, is actively assisting these communities in drafting the very regulations and bylaws needed to reject dollar store development.
And has it been successful?
We have several examples of this success. We've seen land sales successfully derailed, such as in Stockport, Ohio. And we've seen local governments take swift regulatory action, like the town of Lincolnville, which approved a moratorium on major non-residential developments to pause the encroachment of dollar stores while they sorted out their zoning issues.
So citizens are actively organizing to protect their commercial character and their ability to host independent businesses.
That's right.
It's an absolutely fascinating struggle between the hyper-efficient corporate strategy, which targets vulnerability, and the deeply held local values of community control and economic independence.
And we should also briefly note that Dollar General is dealing with extremely complex legal issues even outside of these controversies, including the existence of the Supreme Court case, Dollar General Corps v. Mississippi Band of Choctaw Indians.
What was that about?
That case, concerning whether tribal courts have civil jurisdiction over non-members who commit torts on tribal land, represents yet another complex legal frontier for a corporation whose vast footprint inevitably involves navigating diverse regulatory and governance structures across the country.
So what does this entire multi-layered deep dive mean for you, the curious learner? We have just pulled apart Dollar General, a company that operates simultaneously on two extreme parallel tracks that rarely seem to intersect happily.
On one track, you have the portrait of retail genius, a nearly $38 billion financial success story built on Depression-era closeout tactics, brutally optimized by private equity, and diversified into distinct concepts like PopShelf and DG Market.
They are masters of logistics, distribution, and saturation,
achieving a scale that is genuinely unprecedented in modern discount retail.
But on the intersecting track, you see an entity facing sustained, severe scrutiny. They are officially designated as a severe violator by OSHA for repeatedly endangering employees with blocked fire exits.
Right.
They're facing multi-million-dollar fines and class action lawsuits over systematic deceptive pricing that disproportionately harms their low-income customer base. And they are accused of contributing to the decline of small-town economies they ostensibly serve.
And the central tension here defines modern capitalism in rural America. Dollar General perfected the model of capitalizing on the financial vulnerability of communities that traditional retail abandoned. That power, fueled by these powerful market forces and incredible efficiency, leads to enormous financial success. but often seems to come at the demonstrable, systematic expense of local business ecosystems, worker safety, and basic customer trust.
It's the ultimate example of the razor's edge in high-volume, low-margin retail. The moment your operational efficiency starts to jeopardize human life, as seen in the recurring OSHA violations or ethical pricing, as seen in the millions of dollars in fines, the external costs begin to mount so high they negate internal efficiencies. We saw that perfectly illustrated when they had to abandon the labor savings of self-checkout in 12,000 stores because shrinkage had become too costly.
And that leads us to our final provocative thought for you to explore as you process this deep dive. The discussion we had about local pushback and the new wave of zoning bylaws against DG raises a fundamental question about civic identity and self-determination.
Which is?
In the modern retail landscape, can small towns effectively legislate their own economic and physical identity against a national, highly efficient corporation whose entire model is dependent on rapid rural saturation? When a corporation's financial success relies on exploiting regulatory and economic gaps, the fight becomes less about cheap goods and more about whether local governance can truly withstand the pure force of capital expansion.
A lot to think about, and certainly a company whose moves we'll be watching closely. That's been the deep dive into Dollar General. We'll see you next time.